what he calls a big tech bubble. Dan Suzuki is a Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, great to have you with us. How big is this tech bubble in your view? And tech is very big. I mean, we're talking about large cap technology versus some of the growthier, higher valuation names. Where is this bubble?
I think it's you hit the nail on the head, Melissa. This is a monstrous bubble. I mean, it's it's not just a speculative market, and that's a key distinction. The difference between a speculative market and a bubble is it's pervading society. So it's everywhere you look, and it's all over our economy, our real economy, as well as the market. So I think it's not only expensive and it's big, but it's also pervading society. So I think that the difficulty here is how you manage through a bubble. Just identifying it is only half the battle. Figuring out how you manage through it is the other difficult part. I don't claim to know exactly when the bubble is going to pop. So that I think the only prudent alternative is to, the bigger the bubble gets, the more crowded the bubble gets, to simply continue to shift your portfolio to the other side of the seesaw. There's a vacuum in the markets that's sucking in all the capital. That's leaving other opportunities that are left for dead. And I think that's the real thing that's going to protect your portfolio when and if the bubble pops.
Dan, it's Karen. So thanks for being on. Let's say, though, you have, like I do, I have particular views about parts of the tech bubble, we call it, and other parts of the tech bubble. Do you think we will see a convergence there, maybe, or do you think they just all go down the same? How do you foresee this bubble deflating?
Yeah, Karen, I don't think they're all going to go down the same. I mean, if you just think about what's happened today in terms of the interest rate sensitivity, I agree with you what you were saying before about, the lower multiple stocks by definition should be less duration, less interest rate sensitivity because they have earnings today. What really makes a lot of these high growth stocks, more interest rate sensitivity is you're paying for earnings 20 and 30 years down the line, which, the sensitivity around interest rates is a lot greater. So I agree with you there. Today was, a bit interesting, but I do think, the one thing to keep in mind is, they're all very correlated. And so, the closer you are to that bubble, which any types of tech stocks are sort of in the epicenter within the epicenter of the bubble, the more it's going to be taken down when and if the bubble pops. So something to keep in mind, but I agree with you. If you're trying to avoid the riskiest names, it's those most expensive stocks.
Dan, I hope you had the opportunity to listen to the conversation we had earlier, trying to figure out if the move in rates it signifies an economy that's doing better or if economy that's just sort of going nowhere to lower, but prices getting out of control. I happen to think it's a prices thing, but what are your thoughts in terms of this move in yields and what does it mean for the broader market?
Yeah, Guy, I think it's, to my opinion, my personal opinion is I think it's a bit mixed. I mean, I think the story, this week in rates has been really one of supply and demand and what the Fed's going to do. But I think that, prior to that, there's actually an underpinning of better growth that's coming down the line. I mean, if you think about it, the slowdown in growth that you're seeing today is really a function of Delta, and we're pretty much past the peak there. I think there's plenty of room for recovery. So if you believe that story, it's not only going to be the supply-demand dynamic that's going to drive rates higher, but it's growth on top of that and inflation on top of that. So with those three big drivers, I think that I agree with you. I think rates are going to be higher, and I think there's, it's not going to be a straight line, but I think there's plenty more room to go.
Dan, when you used the term monstrous to describe the tech bubble, that sort of sent the red lights flashing in my mind because I was thinking, well, if it's that monstrous, aren't the entire markets going to go down? I mean, how can the other side of the trade, the value stocks, actually do okay in a market that's going to be taken down by a monstrous tech bubble? So why would you recommend that as opposed to just going to cash if this is such a big thing that you're forecasting?
Yeah, Melissa, it's a really good question. I think that, the ultimate, protection from a bubble is getting away from the bubble as far as you can. And so to some extent, at some point, the cash component may be called for and may be part of that protection story. I think right now, there's other areas of the market that still have so much room for recovery and are not pricing in that recovery, are much cheaper than those tech stocks that, they offer a lot more potential upside. And moving to the other side of the seesaw, it's not all a one-sided train. You can't just rely on historical relationships. Just as an example, 2000 and 2001, that 2-year period where tech stocks were down 50 to 60%, S&P was taken down with it. It was down 20, but small cap value stocks were actually up 40%. Now, who would have thought that small cap value stocks can be up let alone 40% when the S&P is crashing. And that's the power of going to the other side of the seesaw. So if you can find the other side of the seesaw, I think it can offer some protection.
All right, Dan, great to hear from you. Thank you.
Thanks, guys.
Dan Suzuki, RBA Advisors. Tim Seymour, you like these plays on the other side of the seesaw, but what does that seesaw feel like in the meantime when rates are elevated and tech is the driver?
I think we've had rotation in this market since May of 2020, and at times it's felt really uncomfortable. But the banks were running back in May of 2020, and then they ran out of gas. I think there's a lot of that going on. I would still hold to, I don't want to oversimplify this, but there really aren't a lot of other options out there for investors. And to say that suddenly we're going to reverse this passive inflow of capital is the only condition in which you're going to see the entire market get toppled over, to the extent that, I don't think anybody's made that prognostication today. But I ultimately see a dynamic where it's all about the Fed. I know we've talked about the Fed here, but that's the only thing that's going to see this market, and again, a major change in Fed policy that catches the market off guard, that's going to have this market do the kind of a pullback that some people are talking about. I'm not trying to make light of a dangerous day, but I think that's where we are.
Dan?
Yeah, and I think Tim makes a really good point. I mean, I think this conversation took somewhat of a bearish tone on a really bad close, right? And on September 20th, on that Monday, we weren't really afforded the ability to talk about a market that closed at a low, right, over a period of time, because we had that reversal. And I just wanted to say one thing. I mean, I'm relatively constructive on the notion that the economy will start to inflect a little bit, dealing with some of the deceleration that we've seen in Q3 that was unexpected. But for me, what really comes down to is a 10% pullback from the high in the S&P 500 on September 2nd from 45.50 gets you down to that 200-day moving average. You take a lot of excess speculation and exuberance out of the market, and then you get that opportunity to play for new highs and maybe get all the way back to most of those strategist targets at the year end that are above 4,500 or something. But we need a little bit of fear. Guy used the term orderly. That's what we've had so far. Maybe we get a little bit of fear. We get down towards that 200-day moving average, and you bounce from there. That's the opportunity, I think, that the market's going to present you on the long side. I don't think there's anything that says crash right here from the highs.